In the ever-changing world of economics, a term that often perplexes many is the liquidity trap. Picture this: a scenario where monetary policy loses its sway, the interest rates are so low they practically hug the ground, and people are saving more than they're spending, no matter how much money the central bank pumps into the economy. This, dear listeners, is a liquidity trap, a conundrum that can stop an economy in its tracks. Now, to understand how we got here, we need to take a step back all the way to the tumultuous 1930s. The world was in the grip of the Great Depression and traditional economic theories were failing. Enter John Maynard Keynes, a British economist who dared to think differently. He proposed that in a downturn, people and businesses hoard their cash, leading to a vicious cycle of decreased spending and further economic decline. This phenomenon, he suggested, was a liquidity trap, a scenario where interest rates are so low and savings so high that traditional monetary policy becomes ineffective. This concept of a liquidity trap, first introduced during the Great Depression, continues to be a critical part of economic discussions today. It's characterized by near-zero interest rates and a flat demand curve for money. The implications of being in a liquidity trap are far-reaching. Traditional monetary policies to stimulate economic growth, such as lowering interest rates or increasing the money supply, become about as useful as a chocolate teapot. But all is not lost. There are potential escape routes from a liquidity trap. Fiscal policy interventions, such as government spending and tax cuts, can help. They can stimulate demand, encouraging businesses and consumers to pry open their wallets and inject some much-needed cash back into the economy. Throughout history, several countries have grappled with liquidity trap conditions. Japan, for instance, has been wrestling with this economic puzzle since the 1990s. Their ongoing struggle serves as a cautionary tale for other economies on the precipice of a liquidity trap, highlighting the need for timely and effective policy interventions. So, to recap, a liquidity trap is a situation where traditional monetary policy loses its effectiveness due to low interest rates and high savings rates. It's a concept rooted in Keynesian economics and the Great Depression. Being in a liquidity trap can stymie economic growth, but there are potential ways out, like fiscal policy interventions. And real-world examples, like Japan, underscore the importance of understanding and addressing liquidity traps. In the complex world of economics, understanding phenomena like liquidity traps is critical. It's not just about numbers and charts, but about people, businesses, and economies. It's about finding solutions to keep the wheels of the economy turning, no matter what challenges we face. So stay curious, stay informed, and keep exploring the fascinating world of economics.